You're not alone if you've ever thought, living off dividends sounds amazing, but where do I even start? I've been there too, staring at stock charts, overwhelmed by jargon, wondering if it's even possible. That's exactly why this video exists. I've lined up 6 of the most actionable, step-by-step guides to take you from clueless to confident. I'll show you the portfolios you need if you have 5, 15, or 30 years until retirement. I'll show you how to make $5,000 in monthly dividend income with only a $7 a day investment. I'll also share strategies that will pay you dividends every week, starting from the very first week. Stick around, because there's something for everyone in this video. First up,
I'm going to compare 3 different time frames, 5, 15, and 30 years of investing, to show you just how powerful patience can be. And don't worry if you're not familiar with all the investment jargons. I'm keeping things simple and super relatable. In the end, I will show you how time on your side can add over $400,000 to your portfolio. But first, let's talk about the waiting game. Why it feels slow in the beginning. Starting your investment journey can feel like watching paint dry. You invest some money into the market, you're pumped, and then nothing. Weeks go by, months go by, and you're thinking, is this really worth it? This is the story for most people, and today, I'm going to show you why it's perfectly normal to feel that way at the beginning of your investment journey. In fact, I'm going to introduce you to 3 different characters, Sarah, Mike, and Alex, each starting with the same investment but over different time frames. Let's meet them. Sarah is your classic 5-year investor. She's just starting to get the hang of things, dipping her toes into the market. Maybe she has other financial goals coming up soon, a house or that dream vacation, and she's not looking to keep her money tied up for too long. Mike is in it for 15 years. He's got some patience, but he's not thinking super long-term just yet. Mike's main goal is to build a nice cushion for the future without feeling like his money is out of reach forever. Alex, on the other hand, is the ultimate long-haul investor. He's in for 30 years, retirement, a comfortable future, leaving a legacy. That's his focus. Alex understands that the longer he stays invested, the more potential his portfolio has to grow. Now, here's the thing. When Sarah, Mike, and Alex all start investing, it's going to feel incredibly slow for each of them in the beginning, especially Sarah. The first few years, things move at a snail's pace. The stock market fluctuates. Their portfolio might grow just a little, and they're probably thinking, am I doing this right? Is this even working? Here's why. Early on, the growth is linear. You put in money and you might see small gains, but they're nothing to write home about. This is the phase where a lot of beginner investors start to feel frustrated. You've worked hard, you've saved up, and it feels like you're barely making any progress. Sarah, with her 5-year window, feels this the most. And this is where people tend to panic. Sarah might start checking her account every week, watching it like a hawk, expecting big returns. But investing is like planting a tree. You won't see much action at first. In fact, the first few years might feel like you're stuck in the mud. And that's the hardest part for most people. It's slow. It's frustrating. It's so tempting to just pull out and spend that money elsewhere. But what if Sarah, Mike, and Alex all hang in there? Here's a little secret that every successful investor knows. The growth doesn't stay linear forever. There's a reason why all those financial experts keep saying to stay invested. They know that there's a tipping point, a point where things start to shift. And that's where we're going to look at next. It's called the snowball effect, and it's the reason why you can't afford to give up early. Alright, now that we've covered the slow, frustrating start, let's look into what happens when you stick with it. This is the part where the magic begins. It's called compounding, and it's the reason long-term investors always have the last laugh. When you first start investing, it feels like you're pushing a tiny snowball uphill. You're putting in the effort, but it barely grows. That's because early on, the returns you make are small. Your investments earn a little, but that little bit just doesn't seem to make a huge difference. Let's look at Sarah. In her 5-year window, her portfolio might grow a bit, but it's mostly from the money she's putting in herself. The compounding effect? It's still in its infancy. Sure, she'll see some growth, but the snowball is still tiny. If you're wondering, what exactly is compounding? In simple terms, compounding is when the returns you earn on your investments start earning returns too. For example, you invest $1,000, and after a year, it grows by 7%. Now you have $1,070. Next year, instead of just earning a return on the $1,000, you're also earning on that $70 you made the previous year. So your investment value will be at $1,145 instead of $1,140. This keeps happening year after year, slowly at first, but it builds up. Mike, with his 15-year window, starts to see some serious compounding action around the 10-year mark. His portfolio is no longer growing just because of the money he's adding to it. His returns are now generating returns. It's like watching a snowball rolling downhill. It picks up speed, gathering more snow, or returns, as it goes, and suddenly, what was once slow and steady is now accelerating. Now, Alex. He's the one that really gets to witness the full snowball effect. By year 30, Alex's portfolio has taken on a life of its own. The returns he made in the early years are now producing even more returns. His investments have become this compounding machine, and by now, it's growing exponentially. That's the beauty of investing over a long period of time. The longer you're in the market, the bigger that snowball gets. Let's break this down with an example. Assume all three, Sarah, Mike, and Alex, start with $10,000. Each of them earns an average of 7% per year, which is a reasonable estimate for long-term stock market growth. After 5 years, Sarah's portfolio has grown to around $14,000. Not bad, but most of that growth came from the original $10,000 she put in. Now Mike, after 15 years, has around $27,000. This is where things start getting interesting. Notice how in just 10 more years, his portfolio has nearly doubled compared to Sarah's. And finally Alex, who's been patiently waiting for 30 years. His portfolio has skyrocketed to over $76,000. That's the power of compounding over time. The snowball effect means that as time goes on, the returns accelerate. By year 30, it's not just about the money Alex put in, it's about how those early returns have snowballed into something massive. It's all about time. The longer you're invested, the more opportunities your money has to grow. Each year that passes, the compounding effect gets stronger and stronger. And the crazy thing? The biggest growth often happens towards the end. If you compare Alex's growth from year 1 to year 10, it's nothing compared to the growth from year 20 to year 30. The snowball effect accelerates with time. It's important to note that compounding doesn't just happen in good years. Yes, the market goes up and down, but over the long term, history shows that markets tend to rise. If you pull out too soon, you miss out on this crucial growth. It's why Sarah's short 5-year window isn't long enough to see the true power of compounding, while Alex, with his 30-year view, reaps the full rewards. So while it might be tempting to check your account constantly in the first few years and feel like nothing is happening, remember that the snowball is just starting to form. The magic happens later, and the longer you wait, the more the snowball grows, eventually turning into an avalanche of returns. Now that we've seen the power of compounding and how time can transform an investment, you're probably wondering, how do I get started? Well, no worries, I've got you covered. I'm going to build a beginner-friendly portfolio, tailored to a moderate level of risk tolerance and investment goals. I've got a perfect example that'll show you just how powerful a single well-constructed portfolio can be over time. And just like our characters, Sarah, Mike, and Alex, I'll show you how these portfolios can grow over 5, 15, and 30 years. This portfolio combines 3 key funds: the Fidelity 500 Index Fund, ProShares S&P 500 Dividend Aristocrats ETF, and Vanguard S&P Small Cap 600 Value Index Fund. This portfolio provides a great mix of growth, dividend income, and stability. We start with Sarah, who's only investing for 5 years. She puts in $10,000. After 1 year, her portfolio has grown by about $1,042, which brings her total value to $11,042. Not bad for the first year, right? In 5 years, her original $10,000 has the potential to grow to about $16,594. That's a gain of over $6,500 in just 5 years. Her annual dividend income is now $351, up from just $185 in the first year. It's a modest start, but Sarah's on the right track. Still, it's only the beginning, and the real magic of compounding hasn't kicked in yet. Now, let's check with Mike, who's investing for a longer term, 15 years. We know that the 5-year stand was $16,594. Unlike Sarah, if Mike gives it 10 more years, at the 10-year mark, Mike's patience is really starting to pay off. His portfolio will grow to $28,443, nearly tripling his initial investment. After 15 years, his investment will be valued at $50,910. Mike's portfolio isn't just growing from price appreciation, it's also growing from dividends, which have been steadily increasing. His annual dividend income is now $1,913. Now, it's just not his contributions growing, it's his dividends compounding and generating even more income. This is the point where things start to feel more rewarding for Mike, as the snowball effect for compounding begins to build momentum. But what if he waits for another 15 years? That's where Alex comes in, the long-haul investor who sees a significant difference. Let's fast forward to 20 years, where Alex has stayed the course and is now reaping the rewards of long-term investing. His $10,000 investment in 20 years has the potential to reach an impressive $96,523. But what's even more exciting is the growth of his dividends. Alex's portfolio is now generating nearly $4,814 in annual dividend income. That's $401 per month, just from holding on and reinvesting those dividends. At this point, Alex's portfolio has added $86,523 in value, with a big chunk of that coming from the $28,331 in reinvested dividends. This is the snowball effect in full force, where the compounding of returns and dividends really takes off. Now, let's take a look at what happens when Alex keeps his investment for the full 30 years. After 3 decades, his original $10,000 investment has the potential to balloon to a valuation of $447,156. At this point, Alex's portfolio is now generating $38,752 in dividends each year, or about $3,229 every single month, just from dividends. The longer Alex stayed invested, the more powerful compounding became. His portfolio wasn't just growing from the stock appreciation, his dividends were growing too, creating an income stream that now covers more than most people's living expenses. So what's the takeaway? Whether you're like Sarah with just a few years to invest, Mike with a 15-year timeline, or Alex who's in it for the long haul, the lesson is clear. Time and patience are your best friends in investing. For Sarah, the growth was slow, and after just 5 years, the impact of compounding hadn't yet taken hold. But by sticking with it for 10, 15, and 30 years, Mike and Alex saw their portfolios transform into powerful wealth-building machines. The secret? The longer you stay invested, the more exponential the growth becomes. Whether it's through price appreciation or dividends, a small portfolio that's left to grow can change your financial future in ways you can hardly imagine at the start.
Next, I'm going to show you how to make $5,000 in monthly dividend income with just $7 a day using the 3 best ETFs.
$50 a week or $200 a month doesn't sound like much, right? For investing, it's absolutely not enough, right? The short answer to this is a big no. What if I told you you can turn this easy to set aside money into financial freedom? Sounds incredible, right? In this video, I will show you how to reach this milestone using 3 of the best ETFs in the market. And in the end, I will show you an ETF that can potentially 3x your monthly income to over $15,000 per month. Stay tuned. Before we dive into the specifics of each ETF, let's quickly cover what ETFs are and why they are such a powerful investment tool. ETFs, or exchange-traded funds, are investment funds that trade on stock exchanges, much like individual stocks. They hold assets such as stocks, commodities, or bonds, and generally operate with an arbitrage mechanism designed to keep trading close to its net asset value. Through deviation, though deviations can occasionally occur, the beauty of ETFs is that they offer the diversification of mutual fund with the flexibility and liquidity of a stock. There are several reasons why ETFs are an excellent choice for passive income. First, they provide instant diversification, spreading your investment across a range of assets, which reduces risk. Second, ETFs typically have lower expense ratios compared to mutual funds, meaning more of your money is working for you. Third, many ETFs pay dividends, which can be reinvested to compound your returns over time. In short, ETFs combine the best features of stocks and mutual funds, offering both growth potential and income opportunities. After an in-depth review of more than 20 of the best ETFs available, I've pinpointed the top 3 ETFs that have the potential to turn a $200 monthly investment into a powerful wealth-building tool. These ETFs have been selected for their strong performance, resilience, and growth prospects. Let's start with our 3rd best ETF, the Schwab US Dividend Equity ETF, or SCHD. This ETF is a premier choice for investors looking for a blend of growth and income. Managed by Schwab ETFs, this fund aims to track the performance of the Dow Jones US Dividend 100 Index.
This index includes 100 high-dividend yielding U.S. stocks, each selected for its fundamental strength, such as financial health, dividend yield, and consistent dividend payments. This selection process ensures that the ETF comprises top-performing companies known for their reliability and strong financials. The strategy for this ETF is simple. Focus on investing in high-quality, dividend-paying stocks, which allows it to offer both capital appreciation and a steady stream of income. The ETF's expense ratio is impressively low at 0.06%, making it one of the most cost-effective options available. Lower expenses mean that more of your money remains invested, contributing to higher overall returns over time. Performance-wise, SCHD has delivered a notable price return of 112.65% over the past 10 years. This strong performance underscores the effectiveness of this strategy and the quality of its holdings. The ETF's current dividend yield is 3.48%, with a 4-year average yield of 3.26%. It pays dividends quarterly, and investors can opt for the Dividend Reinvestment Plan, or DRIP, to automatically reinvest dividends and compound the returns. The ETF's dividend growth is also impressive. Over the past 3 years, SCHD has achieved a compound annual growth rate of 9% in dividends. And over the past 5 years, the growth rate has been 12.88%. This consistent growth not only provides a reliable income stream, but also helps to counteract inflation. SCHD is well diversified across various sectors. Its largest allocations are in financials, healthcare, consumer defensive, and industrials. The top 10 holdings, which include companies like the Home Depot, Amgen, and BlackRock, represent 40.19% of the fund's total assets. This diversification helps mitigate risks and provides exposure to different segments of the economy. The ETF's focus on financials includes giants like BlackRock and JP Morgan Chase & Co., known for their stability and consistent dividend payouts. The healthcare sector, with companies such as Amgen Inc. and AbbVie Inc., benefits from long-term trends like an aging population and increased healthcare spending. Consumer defensive companies like the Home Depot provide stability, as they sell essential goods that are always in demand. In terms of resilience, the industrial sector features companies like United Parcel Service Inc. and Lockheed Martin Corp., which add a layer of stability through their involvement in both commercial and defensive activities. Additionally, energy companies like Chevron Corp. Offer diversification benefits and the potential for higher yields, especially when energy prices are favorable. Over the past year, SCHD has returned 12.21%, and over 3 years, it has provided a return of 9.13%. The 5-year and 10-year returns stand at 52.14% and 111.13%, respectively, showcasing its ability to generate substantial returns over different time horizons. With a dividend growth rate of 3.48% and 10 years average dividend growth rate of 11.01%, here's how the future projections look for SCHD. Assuming you invest $50 per week or $200 per month, the total annual investment would be $2,400 per year. Over a 10-year period, this investment grows to $42,158, given that dividends are reinvested. Over 20 years, the investment would grow to $192,733. And over 30 years, it could potentially reach $856,688. The dividends after 30 years would amount to approximately $63,967 annually, translating to a monthly dividend income of about $5,331. The total value added over the 30 years would be $784,688, with $402,630 coming from capital appreciation and dividend reinvestment accounted for $382,058. These are no doubt solid returns, but can our next ETF beat that? In the end, I will show you an ETF that has the potential to 3x this value. Let's get into it. The next ETF on my list is Invesco Dorsey Right Financial Momentum ETF, or PFI. This ETF offers a unique approach to investing by leveraging the power of momentum within the financial sector. It is designed to expose investors to companies within the financial sector that exhibit strong relative strength characteristics. Here's why PFI is a solid investment choice and how it can contribute to long-term growth. Managed by Invesco, PFI aims to track the performance of the Dorsey Wright Financial's Technical Leaders Index. This index is comprised of approximately 30 to 50 U.S. financial sector stocks that show strong relative strength characteristics. Relative strength measures a stock's performance compared to the overall market, indicating stocks that have outperformed others. By focusing on these top-performing financial stocks, PFI aims to capitalize on the trend-following behavior of the market. PFI's investment strategy is rooted in momentum investing, a strategy that involves buying securities that have had high returns over the past 3 to 12 months and selling those that have had poor returns over the same period. The idea is that stocks that have performed well recently will continue to perform well, while those that have underperformed will continue to do so. This momentum strategy can potentially lead to higher returns by riding the wave of strong performing stocks. The expense ratio of PFI is 0.60%, which is relatively higher compared to other ETFs, but is justified by the active management and unique strategy it uses. Despite the higher expense ratio, PFI has shown strong performance, delivering a price return of 81.41% over the past 10 years. This performance reflects the effectiveness of this momentum-based strategy within the financial sector. PFI's current dividend yield is 2.11%, with a 4-year average yield of 1.61%. It pays dividends quarterly, providing a steady income stream for investors. The ETF's dividend growth has been impressive, with a compound annual growth rate of 22.96% over the past 3 years and 19.36% over the past 5 years. This consistent growth in dividends makes PFI an attractive option for income-focused investors as well. The ETF is heavily concentrated in the financial sector, with 87.61% of its holdings in financial stocks. This concentration allows PFI to fully capture the potential of the financial sector's momentum. Additionally, the ETF has smaller allocations in real estate and industrials, providing some level of diversification. PFI's top holdings include leading financial institutions such as MasterCard, Ares Management Corp., and JP Morgan Chase & Co. These companies are known for their strong financial performance and stability, which represents 5.12% of PFI's holdings, is a global leader in payment processing, and has consistently delivered robust earnings and revenue growth. Similarly, JP Morgan Chase & Co., another top holding, is one of the largest and most diversified financial services in the world, known for its resilience and consistent dividend payouts. One of the key strengths of PFI is its ability to adapt to changing market conditions. The ETF is rebalanced quarterly to ensure that it remains focused on the strongest performing stocks. This regular rebalancing helps the ETF stay aligned with the momentum strategy and capitalize on emerging opportunities within the financial sector. This dynamic approach helps PFI stay ahead of the competition and maintain its performance over the long run. The performance metrics of PFI further underscore its attractiveness. Over the past 3 years, the ETF has returned 20.15%, and over 3 years, it has provided a return of 5.44%. The 5-year and 10-year returns stand at 35.16% and 80.56% respectively. For dividend investors, it has a current dividend yield of 2.11%, backed by 10-year average dividend growth rate of 13.95%. Based on these metrics, here's the breakdown of future projections. If you invest $50 per week or $200 per month over 10 years, this investment could grow to $37,402. Over 20 years, the investment would grow to $166,927. And over 30 years, it could potentially reach $1,077,002. The dividends after 30 years would amount to approximately $106,826 annually, translating to a monthly dividend income of about $13,402. The total value added over the 30 years would be $1,005,002, with $313,484 coming from capital appreciation and the majority portion, which is $691,519, coming from dividend reinvestment. And now, finally, the best ETF of all for $50 a week strategy is ProShares S&P 500 Dividend Aristocrats ETF, or NOBL. This ETF is an exceptional choice for investors seeking stability and growth through reliable dividend-paying stocks. Managed by ProShares, this ETF focuses on the S&P 500 Dividend Aristocrats Index, which includes companies that have consistently increased their dividends for at least 25 consecutive years. This commitment to dividend growth makes NOBL an attractive option for long-term investors. NOBL's strategy centers on investing in high-quality, blue-chip companies with a proven track record of dividend increases. This focus on dividend aristocrats ensures that the ETF holds companies that have demonstrated their ability to generate consistent and growing income. Such companies tend to have strong financial health, resilient business models, and the ability to navigate various market conditions, which is crucial for long-term stability and growth. The expense ratio of NOBL is 0.35%, which is reasonable given the quality of its holdings and the stability it offers. Over the past 10 years, NOBL has delivered a price return of 118.73%, reflecting the strength and reliability of its underlying assets. The current dividend yield is 2.12%, with a 4-year average yield of 2.03%. It pays dividends quarterly, providing investors with a regular income stream. One of the key strengths of NOBL is its impressive dividend growth. Over the past 3 years, NOBL has achieved a compound annual growth rate of 6.23% in dividends. And over the past 5 years, the growth rate has been 8.68%. This steady growth in dividends is a significant factor for investors seeking a reliable income stream that can keep pace with or outpace inflation. NOBL is well diversified across various sectors, which helps mitigate risks and provide exposure to different segments of the economy. The largest sector allocations include consumer defensive, industrials, financials, and basic materials. This diversification ensures that the ETF is not overly reliant on any single sector, which is crucial for long-term stability. The top 10 holdings of NOBL include well-established companies known for their strong financial performance and consistent dividend payouts. These companies are leaders in their respective industries and have a long history of dividend growth. The consumer defensive sector, which is the largest allocation in NOBL, includes companies like Walmart and Colgate-Palmolive. These companies sell essential goods that consumers continue to buy regardless of economic conditions, providing stability and reliable income. The industrial sector, represented by companies like C.H. Robinson Worldwide and NextEra Energy, adds reliance due to its exposure to both commercial and infrastructure-related activities. The financial sector, with companies like S&P Global Inc. and Aflac, offers stability through their diversified revenue streams and strong balance sheets. The performance metrics of NOBL further highlight its attractiveness as a long-term investment. Over the past year, the ETF has returned 6.16%, and over 3 years, it has provided a return of 10.43%. The 5-year and 10-year returns stand at 42.80% and 118.35% respectively, demonstrating the ETF's ability to generate substantial returns over different time horizons. The dividend metrics are even stronger, with a current dividend yield of 2.12% and an average 10-year dividend growth rate of 15.98%. Based on these metrics, if you invest $50 per week or $200 per month over 10 years, this investment grows to $41,185. Over 20 years, the investment would grow to $210,669. And over 30 years, it could potentially reach $1,601,965. The dividends after 30 years would amount to approximately $238,764 annually, translating to a monthly dividend income of about $19,897. The total value added over the 30 years would be $1,529,965, with $560,127 coming from capital appreciation, and the majority portion, which is $969,838, coming from dividend reinvestment. These are very good returns, but the problem is all of these stocks pay dividends quarterly. Next up, I will show you the best stocks that pay dividends every single month. I will show you the 5 highest paying monthly dividend stocks you can buy today. I will show you how much you can earn from your investment of $10,000. In the end, I will show you a monthly dividend stock that has the potential to pay over $20,000 in monthly dividends. Starting at number 5, we have Apple Hospitality REIT, known by the ticker symbol APLE. This is a real estate investment trust that focuses on investing in income-producing real estate, primarily in the lodging sector. It owns many hotels across various states, making sure of a broad geographical spread that reduces risk and increases stability. It has a current dividend yield of 6.60%. Over the past decade, the company has maintained an average dividend growth rate of 2%, while the average share price has seen a slight decline of -2.47% over the same period. The consistent dividend payouts make it a worthwhile consideration for steady income. Analyst ratings for APLE are positive, while Seeking Alpha and Wall Street analysts both recommend a buy. Looking at future projections, if you invested $10,000 in APLE today, your investment would grow to $10,413 after 1 year. Over a 10-year period, this investment would increase to $17,283. Extending the horizon to 20 years, the investment would grow to $45,074. By the 30-year mark, the investment would be worth $215,280. Paying $41,741 in annual dividends, translating to a monthly dividend income of $3,478. The total value added through this investment would be $205,280, despite a capital depreciation of minus $32,991. The negative capital appreciation is offset by the substantial dividend reinvestment, which would account for a significant $238,271. APLE presents a compelling case for investors seeking regular income and long-term growth. Its stable dividend yield, positive analyst ratings, and robust future projections make it a valuable addition to a diversified portfolio. The company's strategic focus on upscale, geographically diverse hotels and its resilient performance in the face of market fluctuations make it a standout choice for those looking to benefit from the hospitality sector's potential. Next, at number 4, we have Agree Realty Corporation. ADC is also a real estate investment trust, but it focuses on acquiring and developing properties net leased to industry-leading retail tenants. The company's strategy revolves around targeting high-quality tenants and long-term leases, which ensures consistent rental income and minimizes vacancies. These properties are often leased to well-known brands, providing a level of security and predictability in cash flows. It has a current dividend yield of 4.84%, an impressive average dividend growth rate of 6.21%, and an average share price appreciation of 1%. Both Seeking Alpha and Wall Street analysts recommend a buy. Future projections for ADC are also promising. An initial investment of $10,000 in ADC would grow to approximately $10,584 after 1 year, assuming dividends are reinvested. After 10 years, this investment is projected to increase to $19,934. Extending this projection to 20 years, the investment would grow to $57,672. By the 30-year mark, the investment would be worth an impressive $300,591. After 30 years, total dividends received would amount to $51,966, translating to a monthly dividend income of $4,331. The total value added through this investment would be $290,591. Despite a modest capital appreciation of $17,304, the power of dividend reinvestment is evident as it accounts for $273,288 of the total return. The company's focus on high-quality retail properties with long-term leases ensures a steady income stream, while its strategic growth initiatives offer potential for future appreciation. This disciplined approach to expansion and strong tenant relationships further enhance its stability and potential for continued success. The management's ability to navigate economic challenges and maintain strong financial health ensures that ADC remains a reliable and lucrative investment. At number 3, we have Pennant Park Floating Rate Capital with the ticker symbol PFLT. This is a business development company that primarily invests in floating rate loans and other investments made to U.S. middle market companies. The company's focus on floating rate loans makes it particularly attractive in a rising interest rate environment, as these investments can adjust to rate increases, thereby protecting investors from interest rate risk. The stock has a current dividend yield of 10.66%, which is one of the highest in the market for income-focused investors. Over the past decade, the company has maintained an average dividend growth rate of 1.40%. Despite the modest growth in dividends, the high yield itself provides a significant income stream for investors. However, the company's average share price has seen a slight decline of minus 2.22% over the same period. This depreciation can be attributed to market volatility and sector-specific challenges, but is somewhat offset by the high dividend yield. Analyst ratings for PFLT are mixed, with Seeking Alpha recommending a buy, while Wall Street analysts suggest a hold. This discrepancy reflects differing views on the company's risk profile and future performance. Supporters highlight PFLT's strategic focus on middle-market companies and its portfolio of floating-rate loans as key strengths. However, critics point to the potential risks associated with credit quality and the economic sensitivity of the middle-market segment. Future projections for PFLT indicate significant long-term growth potential. An initial investment of $10,000 in PFLT would grow to approximately $10,844 after 1 year. After 10 years, this investment is projected to increase to $26,769. Extending this projection to 20 years, the investment would grow to $115,180. By the 30-year mark, the investment would be worth an impressive $940,073, paying $220,126 in annual dividends, translating to a monthly dividend income of $18,344. The total value added through this investment would be $930,073, despite a capital depreciation of minus $88,989. This negative capital appreciation is offset by the substantial dividend reinvestment, which would account for a significant $1,019,062. Despite the stock hitting $1 million, it lost value due to capital depreciation. In the end, I will show you a stock that has the potential to turn a $10,000 investment into over $1 million and pay over $20,000 in monthly dividends. At number 2, we have SL Green Realty, known by the ticker symbol SLG. This is one of the largest commercial property owners in Manhattan, specializing in acquiring, managing, and maximizing the value of Manhattan commercial properties. With a substantial portfolio that includes some of the most iconic buildings in New York City, SLG stands out as a premier player in the urban commercial real estate market. It offers a current dividend yield of 5.30%, backed by a strong dividend growth rate of 5.83%. Despite a slight decline in the average share price of 1.60% over the same period, the consistent dividend payouts provide a reliable income stream for investors. Analyst ratings for SLG are generally favorable, with Seeking Alpha giving it a strong buy rating and Wall Street analysts recommending a hold. Future projections for SLG indicate substantial growth potential. An initial investment of $10,000 in SLG would grow to approximately $10,370 after 1 year. Over a 10-year period, this investment is projected to increase to $17,677. In 20 years, the investment would grow to $63,600. By the 30-year mark, the investment would be worth an impressive $848,596. After 30 years, the total dividends received would amount to $255,359, translating to a monthly dividend income of $21,280. The total value added through this investment would be $838,596, despite a capital depreciation of $43,651, while the dividend reinvestment would account for $882,246. The company's focus on high-quality commercial properties in Manhattan ensures a steady income stream, while its strategic growth initiatives offer potential for future appreciation. Its strategic focus on Manhattan, combined with its ability to manage and enhance the value of its properties, positions it well for continued success. And now, topping our list at number 1, we have Banco Marco S.A., known by the ticker symbol BMA. BMA is one of Argentina's largest private sector banks, providing a wide range of banking products and services to individuals, businesses, and government entities. With a solid presence across the country, Banco Marco has established itself as a key player in the Argentine financial sector. The bank's extensive network of branches and ATMs ensures broad accessibility for its customers, enhancing its market reach and stability. The bank's extensive network and established market presence position it well for continued success, even amid economic volatility. BMA offers a current dividend yield of 7.99%. Over the past decade, the company has managed to maintain a sector average dividend growth rate of 7.77%. Additionally, the company's share price has appreciated by an average 3.92% annually over the last 10 years. Analyst ratings for BMA are mixed, with Seeking Alpha and Wall Street analysts both recommending a hold. This cautious outlook is influenced by Argentina's economic volatility and the associated risks of investing in the country's financial sector. Despite these challenges, analysts acknowledge BMA's strong market position, sound management practices, and resilience in navigating economic fluctuations. Future projections for BMA are highly promising. An initial investment of $10,000 in BMA would grow to approximately $11,191 after 1 year. Over a 10-year period, this investment is projected to increase to $35,293. Extending this projection to 20 years, the investment would grow to $181,789. By the 30-year mark, the investment would be worth an astonishing $1,586,141. After 30 years, the total dividends received would amount to $296,675, translating to a monthly dividend income of $24,723. The total value added through this investment would be $1,576,141, which includes a capital appreciation of $253,978 combined with a significant dividend reinvestment of $1,322,163. Again, an extremely good return. But next up, I'll show you how you can get paid even faster. In fact, how you can get paid every week.
I'm going to show you how to use 12 carefully selected high-yield dividend stocks to create a steady, reliable stream of income that you can count on every single week. I will explain why each stock is a solid pick and how they fit together to create reliable weekly cash flow. In the end, I will show you how this portfolio and strategy can pay on average $300 to $400 from the first week. Alright, so before we jump into the exact stocks, let's talk about how this weekly income strategy actually works. The idea is simple. You invest in dividend-paying stocks that distribute cash to their shareholders. Here's the problem. Different companies pay dividends at different times. But by carefully selecting stocks with different payment schedules, you can create a system where money flows in every single week. Here's how it works. Dividend-paying stocks distribute profits, usually every quarter, to people who own their shares. For example, if you own shares in a company like Apple, they might pay their dividend in the first week of January. Then another company like Home Depot might pay during the second week, and so on. The idea is to invest in 12 strategically selected high dividend stocks so that there's never a week without cash flow. Let's get into the nitty-gritty. How do you actually choose the best dividend stocks for this strategy? Because let's be honest, not all dividend stocks are created equal. Some are rock-solid cash generators, while others, well, they're more like sinking ships. First, you'll want to look at the dividend yield. This is the percentage of your investment that you'll get back annually as a dividend. A higher yield sounds great, right? But don't be fooled. It could be a warning sign that the company's financials are shaky. A sweet spot is usually somewhere between 4% and 10% for stable stocks, though you can go higher if the company has a strong track record. Next, check the payout ratio. This tells you how much of the company's profits are being paid out as dividends. A payout ratio under 60% is generally safe. It means the company has enough profits left to reinvest in growth. Anything higher might indicate that the dividend isn't sustainable. Finally, consistency is key. Look for companies with a history of paying and growing their dividends. Based on these criteria, I've selected 12 stocks. Each of these companies have been carefully chosen for their consistent dividend payouts, solid financial performance, and ability to deliver results. And most importantly, they all have different payout dates, some paying at the beginning of the month, others mid-month, and some near the end. This means there's always something hitting your account, week in and week out. As for the stocks, let's start with Week 1 stocks, which kick off each month. For January, April, July, and October, we have MLPR, a steady performer with a dividend yield of 9.94%. This stock offers reliability and serves as a strong foundation for your portfolio. February, May, August, and November bring us ABR, a real estate powerhouse with a slightly higher yield of 11.43%. Finally, for March, June, September, and December, FDUS takes over, delivering a robust yield of 12.56%. Moving on to Week 2 stocks, I've got EBF paying out in January, April, July, and October, with a yield of 15.91%. It's one of the higher yielding options in this portfolio. February, May, August, and November feature DHT, a shipping and logistics company with a 9.22% yield. This stock adds stability and diversification to your portfolio. Rounding out Week 2, March, June, September, December introduce FRO, another strong performer with a yield of 10.22%. Week 3 stocks. For January, April, July, and October, BDCX takes the stage with an impressive yield of 16.08%. February, May, August, and November bring us TSLX, a financial sector giant offering a solid yield of 11.56%. Finally, for March, June, September, and December, SURI delivers a yield of 14.01%. Finally, we have Week 4 stocks, which close each month on a high note. January, April, July, and October feature PBDC, with a dependable yield of 9.84%. February, May, August, and November highlight DKL, an energy sector player with a yield of 11.08%. And for March, June, September, and December, BWLP steals the show with an extraordinary yield of 21.33%. BWLP is the crown jewel of this portfolio, providing some of the highest payouts among all 12 stocks. These 12 stocks come together to create a well-balanced high-yield portfolio that will pay you every week. The goal here isn't to chase the highest yield, but to create a reliable income stream that you can count on. In the end, I will explain how this portfolio and strategy are capable of paying out an average of $300 to $400 right from the very first week. All in all, which stocks will pay you in which month? For this portfolio, it should actually look something like Exhibit 1. Since we know what each stock pays in dividends, it should look something like Exhibit 2. Now that we've covered the 12 stocks for building your weekly cash flow strategy, let's focus on how to bring this plan to life. Creating a dividend portfolio that delivers consistent income requires thoughtful planning and ongoing management to keep it aligned with your financial goals. First, decide how much capital you're ready to invest. Your initial investment determines the level of income your portfolio will generate. For this strategy, I will be allocating $10,000 to each of the 12 stocks. Each stock contributes equally to your overall income, ensuring a steady stream of dividends without over-relying on a single company. This even distribution also helps you spread risk. If one stock underperforms or skips a dividend, your overall cash flow won't take a major hit. Now that your portfolio is set up with $10,000 invested in each of these 12 stocks, you're probably wondering, how much can I actually expect to earn? The beauty of this strategy lies in the consistent, predictable income it generates while also allowing room for growth through reinvestment. Let's start with the weekly cash flow. Since these 12 stocks have staggered payment schedules, you're essentially receiving a dividend payout every week. For example, in January, MLPR kicks things off in week 1, paying you $249. In week 2, EBF follows with a much higher payout of $398. By week 3, BDCX steps in, contributing $402. Finally, week 4 rounds out the month with PBDC, adding $246. Add it all up, and your total for January comes to $1,294 straight into your account. The pattern shifts slightly in February. Week 1 brings in $286 from ABR, while Week 2 sees $231 from DHT. In Week 3, TSLX contributes $289, and Week 4 wraps up with $277 from DKL. That gives you a total of $1,082 for the month, slightly lower due to the balance of high yield and stable stocks in the lineup. Then comes March. Week 1 begins with $314 from FDUS, followed by $256 in Week 2 from FRO. Week 3 is a highlight with $350 from SURI, and Week 4 closes with an impressive $533 from BWLP, the store performer with a massive 21.33% yield. Altogether, March delivers $1,453, the highest monthly total in the quarter. These numbers repeat throughout the year, maintaining a consistent flow of income. On average, your portfolio pays between $1,082 and $1,453 per month, depending on the specific stock payouts in each week. That translates to a weekly income of $250 to $350, steady cash flow that you can rely on week after week.
For all these strategies to work, you need very solid dividend stocks that have never cut their dividends in 25 to 50 years. I will show you the top 5 dividend stocks that have never cut their dividends or have been paying dividends consistently for at least 25 years. I will show you how much you can earn in dividends from each stock. I will show you a stock that has the potential to pay over $40,000 in monthly dividends. $40 in monthly dividends. In the end, I will show you a stock that has the potential to turn a $10,000 investment into a valuation of over $10 million. Alright, let's kick things off with AbbVie, one of the leading players in the biopharmaceutical industry. AbbVie has built a solid reputation for its commitment to innovation and consistent shareholder returns. The company was founded in 2013 as a spin-off from Abbott Laboratories, and since then, it has grown exponentially thanks in large part to its blockbuster drug, Humira. AbbVie's history of dividend payouts is impressive. Since its inception, the company has not only maintained its dividend payments, but has also consistently increased them. The company currently offers a dividend yield of 3.62%,
which is quite attractive for income-focused investors. Over the past decade, the company has managed an average dividend growth rate of 14.10%. Additionally, its average share price appreciation over the same period is 12.39%. Based on these numbers, here's the breakdown of future projections for a $10,000 investment. After 1 year, your investment would grow to approximately $11,601. Fast forward 10 years, and that investment could be fourfold to $45,274. Looking even further ahead, after 20 years, you could see an impressive $218,077. And after 30 years, that initial $10,000 investment could potentially be worth a staggering $1,129,870. In terms of dividends alone, after 30 years, you'd have earned about $56,528, translating to a monthly dividend income of around $4,711. The total value added from this investment would be $1,119,870. with $779,261 coming from capital appreciation and $340,610 from dividend reinvestment. AbbVie's commitment to innovation and its strong product pipeline ensure that it remains a leader in the biopharmaceutical sector. The company continues to invest heavily in research and development, aiming to bring new and effective treatments to market. This focus on growth and innovation bodes well for the future, making AbbVie a compelling choice for dividend investors seeking both income and growth. Next on my list is The Home Depot, a giant in the home improvement retail sector. Founded in 1978, Home Depot has grown into the world's largest home improvement retailer, providing a wide range of products, tools, and services for both DIY enthusiasts and professional contractors. This company's size and market dominance make it a formidable player in the retail industry and for dividend investment. The company has a solid track record of paying and increasing dividends for 32 years straight. It currently has a dividend yield of 2.54%. While this may seem modest compared to some high-yield stocks, the company's average dividend growth rate over the past decade is a remarkable 17.57%. Additionally, Home Depot's average share price appreciation over the same period is an impressive 15.98%, indicating strong capital gains for investors. Now, let's project the potential growth of a $10,000 investment in Home Depot. After 1 year, your investment would grow to approximately $11,852. Looking 10 years ahead, that investment could grow to $55,572, driven by the power of compound growth and dividend reinvestment. After 20 years, your investment could reach an astonishing $321,178. And after 30 years, that initial $10,000 could potentially be worth an incredible $1,943,073, paying $64,990 in annual dividends, which translates to a monthly dividend income of around $5,416. The total value added from this investment would be $1,933,073, with $1,567,939 from capital appreciation and $365,134 from dividend reinvestment. If you think these returns are good, wait until you see the upcoming stock that has the potential to pay over $40,000 in monthly dividends. In the end, I will show you a stock that has the potential to reach a valuation of over $10 million. Back to Home Depot. The future outlook remains bright due to its strong market position and ongoing investments in technology and supply chain improvements. The company continues to innovate, ensuring it meets the evolving needs of its customers and maintains its competitive edge. Moreover, Home Depot's strategic initiatives, like expanding its online presence and enhancing customer experience, further solidify its growth prospects. This focus on long-term growth and operational excellence makes Home Depot a compelling choice for dividend investors. Now, let's focus our attention to T. Rowe Price Group, a global investment management firm known for its disciplined approach and strong track record. Founded in 1937, T. Rowe Price has established itself as a reliable player in the financial services sector, managing billions in assets for clients around the world. The company has consistently paid and increased dividends for 37 years consecutively. It currently offers a dividend yield of 4.22%, which is quite appealing for income-focused investors. Over the past decade, the company's average dividend growth rate has been 11.61%. Additionally, T. Rowe Price's average share price appreciation over the same period is 3.51%, showing modest but reliable capital gains for its investors.
Now, let's look at some future projections to understand the potential growth for an investor who invests $10,000 today. After 1 year, your investment would grow to approximately $10,773. Fast forward 10 years, and that investment could grow to $25,110. Looking further ahead, after 20 years, you could see your investment reaching $119,228. And after 30 years, that initial $10,000 investment could potentially be worth an astounding $1,991,081, paying $558,844 in annual dividends, which translates to a substantial monthly dividend income of around $46,570. The total value added from this investment would be $1,981,081, with $198,370 from capital appreciation and a significant $1,782,711 from dividend reinvestment. T. Rowe Price's future outlook remains strong due to its disciplined investment strategies and robust management practices. The company continues to adapt to changing market conditions, ensuring it meets the evolving needs of its clients while maintaining its competitive edge. Moreover, T. Rowe Price's focus on sustainable investing in ESG, or environmental, social, and governance factors is becoming increasingly important in today's market, further enhancing its appeal to conscientious investors. And number 2, we have Lowe's Company, another giant in the home improvement retail sector. The company has grown to become the second largest hardware chain in the United States, providing a vast array of home improvement products and services. The company has built a strong reputation for customer service and product variety, making it a go-to destination for both homeowners and professionals. Lowe's has a remarkable history of dividend payouts. The company has been paying and increasing dividends for 60 consecutive years. It currently offers a dividend yield of 2.02%. The company's average dividend growth rate over the past decade is an impressive 19.84%. To top it off, Lowe's average share price appreciation over the same period is a robust 17.34%, showcasing significant capital gains for investors. Here's the breakdown of $10,000 in this stock. After 1 year, your investment would grow to approximately $11,936. Looking 10 years ahead, that investment could expand to $59,899. After 20 years, your investment could reach a remarkable $378,262. And after 30 years, that initial $10,000 could potentially be worth an incredible $2,554,878, paying $86,942 in annual dividends, which translates to a solid monthly dividend income of around $7,245. The total value added from this investment would be $2,544,878, with $2,096,896 from capital appreciation and $447,982 from dividend reinvestment. The company continues to innovate, focusing on enhancing the customer experience, expanding its online presence, and improving operational efficiencies. These efforts ensure that Lowe's remains competitive and continues to grow. Moreover, Lowe's commitment to sustainability and community support further strengthen its reputation and appeal to investors. And now, the stock that has topped our list is Cintas Corporation, a leading provider of corporate identity uniforms and related business services. Founded in 1968, Cintas has grown into a powerhouse in its sector, offering a range of services that include uniform rental, facility services, and first aid and safety products. This diversity in services ensures a steady revenue stream and mitigates risks associated with any single business line. The company continues to innovate and adapt to the changing needs of its clients, ensuring it remains a leader in its industry. Moreover, Cintas's commitment to sustainability and corporate responsibility enhances its appeal to socially conscious investors. Cintas has a stellar history of dividend payouts, making it an attractive option for dividend investors. The company has consistently paid dividends for 38 consecutive years. The company currently offers a dividend yield of 0.76%. While this yield might appear low compared to others, the company's average dividend growth rate over the past decade is an astounding 21.50%. reflecting its strong earnings growth and financial management. Moreover, Cintas's average share price appreciation over the same period is a remarkable 27.20%, indicating significant capital gains for investors. Now, let's look at the potential growth of a $10,000 investment in Cintas. After 1 year, your investment would grow to approximately $12,796. Looking ahead 10 years, that investment could soar to $116,154, driven by the power of compound growth and dividend reinvestment. After 20 years, your investment could reach an impressive $1,321,682. And after 30 years, that initial $10,000 could potentially be worth a staggering $14,867,649, paying $16,178 in dividends, translating to a monthly dividend income of around $1,348. Although the dividend income appears modest compared to others, the total value added from this investment is astounding. The total value added would be $14,857,649, with $14,761,530 from capital appreciation and $96,119 from dividend reinvestment. I've covered stocks that have stood the test of time. But what if you're looking to supercharge your dividends and see results fast? Up next, I'll show you how to make $1,200 a week with just $10 a day. I will show a tailor-made portfolio specifically designed for this strategy, which will reach the goal 3 times faster than the broader market. In the end, I'll show you a side-by-side comparison of the S&P 500 and the tailored portfolio, explaining why this approach works best for this strategy. But why $1,200 in dividends per week? Let's break this down. $1,200 a week in dividends is a game changer for your finances. Think about it. That's $62,400 a year, meaning a roughly monthly income of about $5,000 without having to clock in 40 hours a week or stress about a side hustle. Since these returns will be in the form of dividends, it's a tangible and realistic target. Unlike I want to be a millionaire or I want to retire early, $1,200 a week is achievable with a steady, smart approach to investing. The beauty of dividend stocks is that they pay you, well, dividends. Regular payouts that can become a reliable stream of income over time. Even if you're starting small, dividends compound. What starts as small payments grows exponentially as you reinvest those dividends and increase your contributions. More on that later. Additionally, $1,200 a week is just the right amount that can make a big impact in most people's lives. For many, it can cover a majority of their living expenses, allowing them to pay bills, take vacations, or just have extra funds to invest further. This is where dividend investing comes in. You don't need a full-time job or a high salary to reach this goal. You just need the right strategy, the right stocks, and a little bit of time. The important factor here is the right stocks. If you want to reach your goal in the fastest way, you need to have the perfect stocks for the strategies. Next, I'll show you how much time you would need if you invest in the basic S&P 500. The S&P 500 is a well-known index that tracks the 500 largest companies in the US, and its performance gives us a pretty solid idea of how the market is doing overall. But how long would it actually take to reach that $1,200 per week in dividends if you're investing in something like the S&P 500 Global ETF, which tracks the global version of the index? First off, we know that the average annual return of the S&P 500 over the past few decades is roughly 8 to 10%. Now, not all of that return comes in the form of dividends. On average, S&P 500 companies pay out about 2% to 3% of their stock price in dividends per year. So if you're aiming for $1,200 a week, you'd be looking for an annual dividend income of about $62,400. To hit that target, you need to have a massive portfolio. Let's say the average dividend yield on the S&P 500 Global ETF is around 2.5% annually, which is right in the middle of the 2% to 3% range. To generate $62,400 a year in dividends, you'd need to invest about $2.5 million. Now, I get it. $2.5 million sounds like a lot of money to come up with, but as the title of this video says, we can only invest $10 a day. Using the chart, we can see that with a daily contribution of just $10, your portfolio will grow slowly at first, with dividends starting to become noticeable after several decades. Based on typical growth rates and dividend reinvestment, it's estimated that it would take roughly 60 years to reach the point you'd be pulling in $62,400 annually, or $1,200 a week from dividends alone. Sounds good to reach there, but let's be real, 60 years is a long time, and unless you're already in your 20s or 30s with a long-term plan, it's not the most practical approach to hitting your goal anytime soon. So how do we speed up the process? In the end, I will show you a tailor-made portfolio that is specifically designed to reach the $1,200 a week target in the fastest way possible. In fact, it will reach that target in less than 20 years.
But first up, you might be questioning if $10 a day is enough. Here's the truth. You don't need a ton of money to start making serious progress towards your $1,200 per week dividend goal. In fact, $10 a day is all it takes to get started. Now, I know that might sound too simple to be true, but stick with me for a second. To hit your goal of $1,200 per week, you'll rely heavily on reinvesting the dividends back into your portfolio. This is where compound growth becomes incredibly powerful. Reinvesting dividends means you're buying more shares, which in turn pay you more dividends. Over time, this creates a snowball effect that accelerates your portfolio's growth. For example, let's assume that the average dividend yield of your portfolio is around 4.5%. You start with a one-time investment of $1,000 and assume an average dividend yield of 4.5% per year. This means at the end of the first year, your $1,000 would generate about $45 in dividends. These $45 in dividends would then be reinvested into your portfolio, increasing the total value. At the end of year one, your portfolio would grow to $1,045. Now, if we fast forward to year two, your portfolio is generating 4.5% of $1,045 in dividends. This would add an additional $47.03 in dividends, meaning you'd earn an extra $2.03 in the second year. This amount slowly grows over each year. At first, the difference is not noticeable, but later on, when you reach a certain point, the difference becomes very noticeable and the growth becomes exponential. But for this to work for you, you need to build a portfolio that is tailored to growing the dividend amount. When it comes to choosing the right dividend stocks, you've got to think a little strategically. After all, the goal here is to build a portfolio that will generate enough income to reach that $1,200 per week target, and to do so in the most efficient way possible. So how do you pick the right stocks? Let's break it down. One of the easy ways to get exposure to a diverse range of dividend stocks is to invest in income-based ETFs, or exchange-traded funds. These ETFs offer instant diversification, reducing risk, and are especially useful for beginners who don't have time to monitor individual stocks. Covered call ETFs are another type to consider. They invest in dividend stocks and use options to generate additional income, which can boost your overall returns. Why go this route? Well, ETFs give you instant diversification. Instead of picking individual stocks, you're already investing in a basket of companies, which spreads the risk. They're particularly useful if you're just starting and don't have time to monitor individual stocks regularly. Next, I like to include REITs for a quick boost. REITs are required to pay out at least 90% of their income as dividends, making them a solid source of high yields. You don't just want stocks that pay dividends now, you also want to focus on stocks that have a track record of increasing their dividends over time. Dividend growth stocks not only pay regular dividends, but also increase those dividends year after year. Companies like Broadcom, AVGO, and Caterpillar, CAT, are known for their solid dividend growth, making them excellent options for long-term income generation. To reach your $1,200 per week goal, you'll need a mix of high dividend yields and long-term growth potential. Now that we've covered how to choose the right dividend stocks, it's time to build your actual portfolio. You want to make sure the mix of stocks you choose is both high-yielding and well-diversified. The goal here is to generate the steady stream of passive income you need to eventually hit that $1,200 a week in dividends, and only with a $10 daily investment, the fastest way possible. Here's an example of a diversified dividend portfolio that will help you reach your goal faster. These are the stocks I will use for this specific strategy: CubeSmart, Broadcom Inc., Lennar Corporation, American Tower Corporation, First Trust Buy-Right Income ETF. You might be wondering why these specific stocks. Well, here's why each of these choices is vital for hitting your $1,200 a week goal. Each stock here serves a different role. The REITs, Cube and AMT, offer high dividends and steady income. Broadcom and Lennar give you that balance of growth and dividends, while FTHI adds extra income through covered calls. All these stocks have a history of consistent dividend payments and even dividend growth. If you have a portfolio of these stocks, that portfolio will have a dividend yield of 3.60%, a dividend growth rate of 20.55%, and an average share price appreciation of 13.05%. Let's break down how this portfolio would grow over the next few decades if you stick to your strategy of investing $10 a day or $3,600 annually into dividend-paying assets. In the first year, your portfolio will have a value of $3,600, reflecting only your initial contributions without much return from dividends yet. But this is the foundation for future compounding. At the 5-year mark, it will be valued at $25,507. By year 10, your portfolio grows to $87,503.
Fast forward to year 19, and your portfolio will be valued at $657,932. By now, you'll be receiving an annual dividend of $68,566, or about $5,713, meaning a weekly dividend income of about $1,300. The key takeaway from this is that we hit that mark in 19 years. Compared to the time it took the S&P 500, the customized portfolio tailored for this specific strategy is the fastest way to reach $1,200 with just a $10 daily contribution. You can clearly see that the time required by the portfolio, which is 19 years, is 3 times less the time required to reach the same level using a broader market like the S&P 500. This accelerated growth is primarily due to the higher dividend yield, consistent reinvestment, and the strategic stock selection, allowing you to reach your income goal much sooner. Want to know how to turn a $7 daily investment into a $1 million portfolio that pays the same amount of monthly dividend income? Click the video on the screen to find out.